So welcome back, everybody, for another webinar organized by Princeton for everyone worldwide. We're very happy to have Arvind Krishnamurthy with us. Hi, Arvind.
Hey, Marcus. Thanks for having me on.
Great to have you. Arvind will talk about quantitative easing. What have you learned so far? So we're looking forward to his talk. So before we go to Arvind, let me just give a few opening remarks, and then we'll learn from Arvind more about QE and perhaps also a little bit about QT, quantitative tightening. So if we look at monetary policy, there are different channels which you can work on. You can affect consumption demand. You manage aggregate consumption or redistribute wealth by moving wealth from low marginal propensity consumer households to high marginal propensity consumer households. Or you can also affect the portfolio choice. And this way you affect risk premium. You also redistribute, but you give it to people who might be less risk averse or have a higher productivity, and this way you affect the outcome of the economy as well. QE programs are mostly, they're all about asset purchases, and you can buy government bonds, and a particular way to buy government bonds is like a yield curve management. You affect the return premium. And of course, there's interaction between the central bank and the debt management office or the treasury. Or you can also buy mortgages and corporate bonds. You also then affect also the risk premium. And another form of unconventional monetary policy is to have negative interest rates. You hit the zero lower bound or the effective lower bound or the reversal rate at some point, and then you can't go further into negative territory. Now, if you talk about quantitative easing and asset purchases, the central bank essentially swaps a fixed interest rate government bond for floating reserves. By floating, I mean the interest rate is floating, depends on the policy rate. Whatever interest you get on the reserves is moving around based on the policy rate. And the question is, if the central bank is actually, buying these long-term bonds, takes it out, and at the same time, the treasury is just going the opposite direction. So is it like the treasury shortening the debt maturity? Or is it simply a wash where on the one hand, you take out long treasuries, replace it with floating reserves, would have been the same if the treasury or the finance ministry or the debt management office is just offering a shorter debt maturity for its government bonds. And if it's a wash, it might not do anything. Hence, can we conclude really QE really works only if it involves risky assets like corporate bonds or mortgage-backed securities and other of these things? Or is it driven by a political game between the central bank and the treasury? So if essentially the argument is the following, the central bank hikes the interest rates after QE, and if it hikes the interest rates after having bought a lot of these long-term bonds, the central bank will suffer some capital losses. So there will be capital losses from the central bank because it has bought these long-term bonds, and then the interest rate goes up, the long-term bonds lose in value. And the question is, how long can the central bank sustain such losses? That depends very much whether the treasury is actually recapitalizing the central bank. And if this is difficult, then it's very costly for the central bank to hike interest rates later on. Hence, ex ante, it signals that the interest rate will stay lower for longer. And this way, it has some signaling effect to it. It would also, the signaling channel, this particular one outlined here, and Arvind will talk to many more of the signaling channels. This particular one means an undercapitalized central bank, which has bad relationships with the finance ministry, is more powerful in signaling that it will stay at the lower interest rate environment for much longer. So the other thing I would like to say, how does the QE change the effectiveness of interest rate policy subsequently? And what's the optimal sequencing within QE and interest rate policy? So as I said, QE is a swap of bonds for reserves. And you can think of as a bond as a safe asset, which everybody can hold, but with a fixed interest rate, while the reserves have a floating interest rate, but only the banks can hold. And you have depicted a balance sheet of a bank where they have some reserves, and they also have some government bonds, some other loans that got to the real economy. And then they have deposits. And of course, what happens when you change the interest rate or the policy rate, you change the relative value of these reserves relative to the bonds, because the interest rate on the bonds will stay high. The reserves, you cut the interest rates, the interest rate is going down, and typically the deposit interest rate will go down as well at the same time. So typically what you do is when you cut interest rates, the bond value goes up, and this actually recapitalizes the banks. So the benefits, because the refinancing becomes cheaper for the banks, so the equity or the net worth of the banks is expanding. That's what we call, Julie and I call, stealth recapitalization. So interest rate move also recapitalizes the banks. And that's one way to stabilize the economy. So in particular, if the banks or any other sector in the economy you're targeted is in financial difficulties, you can actually stabilize the situation. And QE, as I said, the central bank signals that the rates will stay low for long, so the revaluation effects will be much more dramatic. But there's also a second effect, which I would like to highlight. After QE, the banks will have fewer bonds and they will have more reserves. And that means the effect subsequently will be less redistributive because there are just not so many bonds out there. So the revaluation effects will be smaller. And then this causes a question or an issue that if you do a QE and then subsequent the interest rate cut will be less effective. Hence the optimal sequencing is first to cut the interest rates all the way down and then only then do QE. And if you go for quantitative tightening, you want to go the opposite direction. First you do quantitative tightening and then you only hike the interest rates. Because essentially if you do quantitative tightening, if you do it the other way around, the interest rate hike will be less effective. So first put the long-term bonds into the economy and then hike the interest rates. So that's about the optimal sequencing from this particular angle, viewed from this particular angle. But more broadly, the question is, if you have this redistributive monetary policy perspective that you shift wealth around, either through demand management, because you want to stimulate a certain consumption, shift it to high propensity consumers, or you want to shift it to certain sectors which are balance sheet impaired. The question is, where's the bottleneck? And where do you want to shift it to? And you could argue that in the global financial crisis and after 2008, after Lehman, the household sector was primarily balance sheet impaired, while in the COVID crisis was more the corporate sector was more impacted. Or in Japan in the 1990s, the corporate sector was much more impacted. The financial sector is typically always involved as well. But if you want to shift wealth to the household sector, QE should involve primarily mortgage-backed securities because you boost up the house prices and this helps the household sector. If the corporate sector is financially impaired, you want to buy more corporate bonds because you help the corporate sector to refinance itself much more cheaply. So all of this, you want to look at where's the bottleneck, which sector in the economy is balance sheet impaired, and then help this particular sector. And then by doing so, of course, you change the price of risk or the risk premium on this whole thing. And by helping this impaired sector, you help the whole economy, and it's actually can be a Pareto improvement. So even when you redistribute from one sector away, the economy will get stimulated, so everybody can be better off. So it's not a strict redistribution in that sense, that you take something away and give it to somebody else who will end up hurting the first group because they also benefit from the economy doing better. So with this, let me go to Arvind's poll questions, which you answered before. And so how much role did QE play in driving the asset price boom in the last decade? A little to none, moderately, or it was a central factor? And the answers were 6%, 47%, and 47%. So it's moderate or quite a lot. It was a central factor to drive asset prices up. So more than interest rate moves, it was more the QE to some extent. And the second question, how much was the role of QE to support recovery of the economy after 2008? And again, little to none, moderately, or the central factor. The answers were 11%, 53%, and 36%. So really important factor. So everybody contributes quite a bit to QE. And then the third question was, what are the areas of QE research that we should do, which with most understanding we need? And they are actually, should we work mostly on asset pricing and QE, or the impact of QE on banking and firms, or QE and monetary aspects? Or should we also build macro model which integrate QE, and that makes an important element to it? And the answers are pretty evenly split. So it's 24%, 19%, 23%, and 35%. So the D gets a little bit more macro modeling to integrate QE, but otherwise it's pretty evenly split. So let's see whether we change our minds after we listen to Arvind, and he will tell us what the big holes are in our research agendas. Thanks a lot, Arvind. Looking forward to your presentation.
Okay, thanks, Markus. I'm just going to share my screen. Okay, so thank you once again, Markus, for having me here on this this great seminar series, and thank you to the audience for listening to what I have to say about this topic. You know, in a way, as the poll questions show, there are still lots of open questions around QE. You know, we have sort of this gut feeling that it's had an important effect on asset prices and has an important effect on economic growth over the last decade. But we don't really understand exactly how. And in a sense, the answer to the last question tell us that all the little pieces that we think might be relevant for how QE impacts the world, we're still unsure which pieces matter the most and which pieces matter the least. So what I'm going to try to do in this talk is, you know, take stock of what at least I have learned about research over the last 15 years on QE. The slides, by the way, that I'm going to walk you through are posted on my website, and there are references to some papers that people can look at. And then I can, as I go through this, maybe I'll try to give you my own view on where I think the research is strongest and where the research is, in my mind, weakest. Okay, so just to step back, you know, what would researchers, policymakers really like to understand about QE? I'd say it's in a sense, you'd like the narrow question, which is, what is the impact of a given size of purchase? You know, $1 of, say, mortgage purchases in a given asset market, say the mortgage market, in a given economic state, you know, in a boom, a recession, a financial crisis. What's the impact of that on the macroeconomy? That's sort of the answer we'd want. And there's a collection of conditionalities there that we'd like to have an answer to. And then when we say macro, there are a broad set of questions here: impacts on output, distributional consequences, international spillovers, inflation, financial stability, fiscal effects, some of the stuff Markus put up on his slides. And then there's this other very important question, which is QE is a particular policy tool. And how does this particular policy tool compare to the standard policy tool that central banks have, which is to set the short rate and then indicates where the path of the policy, the short rate, is going to go over the next couple of years. Okay, these are the questions which we would like to have answers to, and these are questions that research has given thought to over the last decade. So what I'm going to do in this talk is run through research findings fairly selectively, and as I said, talk to you about what I think we know more about and what we know less about, and then talk a little bit about where the research goes from here. The talk is going to start with asset pricing, which I'd say most of the early work on QE was really asset pricing event studies. So I'll start by talking about that. I actually think we've learned quite a lot from the asset pricing event studies, and it's the most, in my mind, solid evidence for how QE works. And then I want to talk you through transmission into banks and firms, and then come back and talk about macro. Okay. So let me start here. This is a picture from a paper I had with Annette Wissing-Jorgensen, looking at one of the early QE announcements of the Fed. This is the March 18, 2009 announcement, where the Fed indicated a big expansion in purchases of treasuries and mortgages. The announcement is made, you can see here, at 2:15. Treasury yields drop by on the order of 40-50 basis points. There's a big increase in trading volume. It's very tightly connected to the announcement, and it's very salient. Both yields fall as well as trading volume rise, indicating that that there's a QE effect that's very present here. So the asset pricing work around QE is built around this type of study, an event study around a QE announcement. Event windows are very tight. So, usually the issue when you look at the impact of policy on the economy is you have an identification challenge, which is perhaps it's what's happening in the economy that's causing the policy reaction. But with a lot of the QE event studies, the event windows are very tight. So it's very clear it's QE related rather than anything about an omitted variable or reverse causality. The identification challenges then are different, and in QE it's really about the channels through which QE ends up affecting yields. So Treasury yields fall 40 basis points in that announcement. Why have they fallen 40 basis points, right? And I'm just going to lay out a couple of different ways of thinking about why interest rates fell by so much on that event. One is what I'm going to think about as conventional broad channels. So if QE is coupled with signals about the path of the policy rate, right? QE is an easing move by the central bank. And if that signals also further easing through conventional mechanisms through the path of the policy rate, then you would expect that interest rates would fall for conventional reasons upon a QE announcement. And that interest rate fall via expectations hypothesis, say, should be expected to affect short, medium, and long-term rates. That's a signal of the path of the policy rate. QE could also signal something about policymaker preferences. If you're thinking about the path of the policy rate through a filter about, say, what is the central bank's Taylor rule coefficients, then, and you're not sure about the central bank's Taylor rule coefficients, then a QE action will make investors update what they think about policymaker preferences, and that too will have an impact on expectations about the path of the policy rate. I still say this is a conventional broad channel, because if you think that the Fed that does QE is also going to be easy with respect to the short rate, that is an interest rate effect that is within the class of moving short rates as it would, say, via forward guidance, right? And then the other thing that I'd say is conventional, that also comes up whenever you think about conventional monetary policy, is signaling news about the economy, right? If the Fed's doing something because it's responding to news, then that news itself is information about the economy, which should be expected to affect asset markets. So in contrast to conventional broad channels, another possible way in which QE can work is through narrow channels. So for example, and this is a channel that has received a lot of attention. If, for example, risk premia on mortgages are particularly high and the Fed goes out and buys mortgages, then maybe a channel through which the Fed will be affecting mortgage rates is by removing mortgage risk out of the market, then reducing the risk price on mortgage risk, and so as a result reducing mortgage rates. Similarly, if the Fed takes out a lot of long duration assets by buying, say, a lot of long treasuries or long mortgages, then the net amount of duration held in the private sector falls, and you might expect that duration risk premium would fall. This is an effect that is running through risk premium, very tied to buying and selling assets, particularly risky assets. It's not about the path of the policy rate, right? So there are these different things that can be happening with QE, and almost surely all of these things are happening. So when we evaluate QE and try to understand how QE is working, we need to be able to sort out which of these things is happening. And there's two aspects of that. One is a research aspect. A research aspect is simply just to understand how this mechanism is impacting the economy. We need to sort of parse out how much of each of these things is at play to understand mechanisms at work. There's also a policymaker reason to understand this. For example, if you think QE is working by signaling the path of the policy rate, then a conclusion you might yield is, let's not do QE, let's try to strengthen our communication, say via forward guidance about the path of the policy rate. If QE is working by helping the Fed communicate better about the path to policy rate, then you don't need QE, you can just communicate better. So if you thought it's working through conventional channels, then there are perhaps alternative ways to also run QE. In contrast, if you thought that QE was working particularly importantly through these unconventional narrow channels, then you might conclude that QE particularly matters when risk premium are high, right? If what's happening is the Fed goes out and buys mortgages and that reduces mortgage risk premium, then that tells you that the impact of QE will depend upon the current state of risk premium. So sorting the stuff out is important both for a policy perspective as well as from a research perspective.
Arvind, can I ask you a quick question from? So one is the broad channels you call. Essentially, why is QE better than forward guidance, or why do you will go into that, I guess?
I'm not going to go into that, Marcus, but I'd say that is to me a policy question that needs to be sorted out. So if research can tell us how QE is working, and for example, suppose a research told us that QE was primarily working most of the time this way.
Yes.
Then you would say QE is substitutable for forward guidance.
Okay.
If instead I told you QE works through here, but also works here, and maybe I told you it worked particularly well through here, and I will say this as I go through, particularly well through here during times of financial distress, that tells you that those two policies are not substitutable.
The other question Eugene Kendall was asking is, if it's a signaling channel about the economy, are you sure the causality goes in this one direction? So he argues that it could be that the Fed knows more about the economy as you propose, but it could also be that QE is essentially driven by the information, or the other way around. Is the causality, is it clear the way it goes?
I mean, you can run it in either direction. Either the Fed signaling news about the economy because it knows something when it takes the action, or the Fed is responding to news about the economy. If you say the Fed's responding to news about the economy, then it comes back to this. I think the nice thing about the tight event window is it's not news about the economy that evolved in that 3 minutes
Yes.
at which the policy announcement happened. So it's very unlikely that the Fed is responding to a 3-minute policy news and then went out and did QE. That strikes me as unlikely. What's likely here is the Fed's doing something and the market's moving rates, either the market's moving rates because of the action the Fed's doing or because of information the Fed's conveying by taking its action.
And if you extend this window, it's a permanent effect. It's not just for 1 or 2 days and then drifts back.
Yeah, I mean, as you go longer with these event windows, your power starts to fall. So it's the sort of usual type of, for those who have done finance event study, you know that narrow event window gives you lots of power and you lose as you go further out.
Yes.
So I think the answer is we don't know, but I should state that this event particular, for example, the one that Nat and I study here, is an announcement. It's not the actual purchase. So purchases are often coming 6 months later than these announcements. So these are not microstructure effects of the Fed going out and buying treasuries. These are the Fed saying, I'm going to be buying treasuries in 6 months.
Have you also looked at events where the Fed says we stop our QE? And
yes, there's interesting events in which, I mean, the most famous event is the taper tantrum.
Yes.
Where in 2013, the Fed gave signals that they were likely to curtail their QE, and then you see a reverse of this type of effect, right? And so then you can also ask the same question about that reversal. Is it reversing because of the market thinking the Fed's stopping doing QE and therefore it's going to raise short-term rates? Or is it because of the fact that the Fed's not going to be buying so much, or maybe selling, and that sales is going to have a big impact on asset prices? The same issue, Marcus, we can talk about this later, but will pop up when we talk about QT.
Okay.
But in a sense, these sets of issues are present with QE, and you can't avoid them. You have to sort of figure out how to parse them out and separate things and think which channels are operating when.
You will also talk about whether you want to surprise the market or not. I mean, with QT, we don't want to surprise, or with removing QE, you don't want to surprise the market, but with QE starting it, you might want to have a surprise or not. Can you say something about that?
I don't have anything to say about surprise versus no surprise. Yeah, I mean,
so one big lesson of the taper tantrum was we really now prepare the market through speeches and all this to avoid a taper tantrum.
Yeah, I don't think I have. I don't think anything about QE research particularly tells us about surprise versus not surprise. It's clear that even when you think about conventional monetary policy, the central bank goes to great pains to lay out their plans. And maybe one way of thinking about that is to reduce uncertainty about stuff. I mean, that's, say, John Taylor would be a big proponent of rules for that reason. So I don't think I have anything to say particularly about QE with respect to that.
But one could argue that your estimates is an underestimate of the effect because.
Oh yes, absolutely. I mean, and that's so if to go back to the first question I raised, what you'd really like to know is, I buy $1 of some asset in a given state, how much impact does it have on the macroeconomy? And the problem with the event studies is that the market has an expectation that the Fed's going to buy something, and the Fed says it's going to buy something different. And so it's in response to the delta of what the Fed's expected to buy, which is surely an underestimate of the full effect. But what the event studies help us do is, given an event of some change, some delta in what the Fed's going to buy, you can see all of these potential channels at play. And so you can difference out things as you look within the event. And that's not a function of the size of the shock, because all of these channels will just scale up with the size of the shock. Move on?
Yes.
Okay.
Thanks.
I want to say just a little bit more about narrow channels, and then I'll show you some more data. And I'm doing these two narrow channels particularly because I'm going to talk a little bit about a paper that thinks about these narrow channels. So, you know, a lot of QE has been focused on changing the supply of safe assets. So buying and selling treasuries, buying and selling bunds or gilts. We know, and for example, this is some other work I've done with the net, that investors have mandates for and special demands for safe bonds, so that if you were to change the supply of safe bonds, you're going to be moving along an investor's demand curve for safe bonds, and that will impact yields. Okay, so that's a narrow channel. That's a specific narrow channel that you might expect to play out when you're changing the supply of safe assets. I could say the same thing in the context of mortgage-backed securities. There's investors who have specific mandates to buy mortgages. If you change the supply of mortgages, you'll change the supply of what's available to buy, which will trace along a demand curve. There's another way of thinking about narrow channels, which is also present and maybe happening simultaneously, which is risk premium. And I mentioned this before. If there's an investor SDF that say is a function of the quantity of risk held by that investor, then changing the quantity of risk by the Fed, say, pulling risky assets out of the economy, will then change the risk price, and then should be expected to change the risk price across a bunch of assets. This is also a way to think about QE, and an answer that this way of thinking about QE gives, which is particularly pertinent, is how narrow. And what I mean by that is, if you buy mortgages, you're changing mortgage risk. Maybe does that change mortgage yields? What else does it change? And to answer that question, the theory question is, what else does this SDF price? And then the empirical question is, what are the spillovers that I see when I buy some assets? So I'm going to say a bit more about each of these things as I go through. All right. Let me walk you through, I think, a very nice event study. This is from a team at the Bank of England looking at the UK's gilt purchases. So in 2009, the Bank of England said that they were going to buy long-dated gilts. Okay, the black line here are changes in yields around this announcement by maturity. And when you look at just the black line, this actually looks a lot like a conventional monetary policy shock. So conventionally, you know, if the central bank was to say they're going to lower short rates, you'll see a big reaction in the near term, smaller reaction in middle maturities, and an even smaller reaction in long maturities. So if you just looked at this, you'd say, this is not about QE. This is mostly about the conventional channel through which the central bank is impacting short-term rates and medium and long-term rates. You get a little bit more of a sense that something else is going on when you compare the gilt yields to the OIS yields. So the gray line here is the change in the yield OIS spreads. And that spread move is smaller than the black line. If you think, for example, so one hypothesis when you look at that first thing is, the OIS curve is moving, say, for conventional monetary policy reasons. And if that was the case, then the additional part is the part that's due to the change, the effect of the central bank's gilt purchases, right? So there's both that are floating around on the left-hand panel.
So can you explain OIS quickly?
OIS swap curve. This one is interesting because the Bank of England is buying gilts, but it's not as if they're buying swaps. They're buying interest rate swaps are being traded in the market between players. They're buying gilts. You can see gilt yields fall. A conventional channel would impact both gilts as well as swaps in a sense equally. The fact that the yield OIS spread moves about half of what the gilt moves tells us it's not moving equally. So it's not just a conventional channel. There's an additional effect that must be due to the QE purchases of moving gilts. So that shows up to some extent here. You can the March 4th announcement is really, in a way, cooler for identification. And I'll tell you what I mean by cooler. So on March 5th, the Bank of England announces that their purchases are actually in a tight range between 5 and 25 years. The early announcement was, we're just going to buy long-dated gilts. Then the Bank of England comes out and says, no, we're going to buy stuff in the 5 to 25-year range. And now you see a pattern that doesn't look like conventional policy. This looks very much like QE policy. And why do I say that? Look, it's the black line are gilt yields falling in the 5 to 25-year maturity particularly. It doesn't look like the conventional policy reaction of a curve change that looks like this. Moreover, a second thing that you see here is the change in gilts is very closely matched to the change in yield OIS spreads, which is to tell you that the bulk of the move in the gilt curve is a move in the gilt curve. The OIS curve moves much less. So when you look at this particular picture tells you that there's a big component of QE that is when the central bank buys gilts, gilts move a lot. Not for conventional reasons, but gilts move a lot. OIS curve also moves, but much less. Maybe if you look at these two pictures, you'd say gilts move, say 100 basis points, and the OIS curve moves about 20 basis points. So there's some spillover, but there's mostly about the specific asset that you buy, right? And that's what I mean by a narrow channel.
Just to give you an example, so an example would be that the gilts I can use as a good collateral, while the OIS swaps I cannot.
That's one way of thinking about it. In a way, I think that's the research question. What is it? Why is it that the central bank, by buying gilts, is moving gilts a lot, but isn't necessarily moving OIS curve? And so two ways of thinking about this are gilts are special assets that are good collateral, that are in high demand by pension funds, say in the UK, looking to defease future obligations. And so if you suck out some gilts, you're going to make gilts more expensive, and that's why these yields fall. Swaps are not the same thing. And then why is swaps moving? Well, maybe an answer is both gilts and swaps are long duration assets, and there's an SDF that's pricing both of them. And so then the spillover here is a component that's due to collateral and a smaller component that's due to the SDF pricing both as being interest rate risk relevant.
So what's striking on this figure is also is that there's somehow a change between the 14-year maturity and the 15-year maturity. There's a jump even in the OIS and in the gilt.
Yeah.
Do you have any explanation for that?
I don't.
Both in February and in March.
Yeah. I don't have an explanation for that. We can ask them. You should have them on and ask them about this curve.
Okay.
I'm guessing it's particulars of the gilt market in this maturity spectrum. I mean, I think I know more about the treasury market. It might be that in the treasury market, the 10-year bond is very actively traded, and then stuff between roughly 10 and 30 is not that actively traded. So there's always going to be some sort of market-specific liquidity effects that might be playing out. So maybe something like that is at work here. I don't know.
But the OIS, they shouldn't. Do you think it's also more liquid?
And yeah, the OIS. Why is the OIS matching that? Yeah, I don't have a good answer. Okay. We could also say, I mean, this is event studies, so there's always sort of noise with these types of things. So I am not sure how much I want to ascribe to particular differences in data here, but here's another really nice announcement where you can see these same types of effects playing out. This is from D'Amico and a team at the Fed, who look at a event around the Fed's news regarding reinvestment of their asset portfolio. This is August 10, 2010, and the Fed's reinvesting their existing asset portfolio. And on 2/15, the Fed news is we're going to reinvest in long-term bonds. And so here are prices of 9.5-year bonds, 10-year bonds, and 14-year bonds. All of these bond prices move up upon this news. The market inferring the Fed's going to be buying long-term bonds. Then on 2:45 here, the Fed says, actually, no, we're only going to be buying bonds under 10 years. And you can see here, the 9-year bond price remains high, but the other ones come down. So when you look at these last two things, one of the things that really jumps out at you is what the Fed buys or what a central bank buys has the biggest impact. It's not as if the other stuff doesn't have an impact, but it's much smaller than the impact of the purchases. And you see that here, you see that on the previous graph. That's very strong support for the existence of a fairly sizable narrow channel for the way in which purchases work out.
So, Arvind, can I ask a different question? Are there natural events where the U.S. Treasury decides, to issue something at different maturity, which would not have, what do you call communication channel or the standard conventional channel?
That's a great question. So, one of the difficulties with sorting through QE work and figuring out the mechanisms by which QE is impacting asset prices is because the central bank going out and buying stuff has all sorts of other implications for the world. For example, I haven't even talked about this, but when the Fed buys QE, they're also buys treasuries, they're also injecting reserves into the system. So there's a collection of other things at work. And parsing through, what you'd really like is a narrow particular channel at play, which, Marcus, as you point out, sometimes happens with a change in fiscal policy regarding maturity structure. So, there's like a famous old example of when the US Treasury stopped issuing 30-year Treasury bonds. This was a surprise announcement. I think it was like 2001. And you saw distinctly the long end of the Treasury curve yields falling a bunch because it was clear that there was less 30-year Treasury bonds coming out in the future. So there are events like that. I know of some other events along those lines, which look like narrow channel events along these lines. So in that sense, the two data points I'm just showing you are actually consistent with other stuff that looks like demand and supply factors that play out. But I think what I also wanted to make the point, and maybe here it's very clear, this is a very significant portion of some of the QE events, right? There's also potentially signaling effects through conventional, but there's also importantly narrow channel effects here that are playing out through the specific asset that's being bought. There's a bunch more papers that I think come to similar conclusions looking at different types of asset purchases, and I'll just mention a bit of this. And for those of you who are interested, you can click on some of these links on the slides. I have some papers with Annette looking at mortgage-backed purchases, which come to the conclusion that MBS purchases moved MBS yields the most. Moved other stuff, but moved the MBS yields that the Fed was buying the most. There's some work in Europe on the ECB's announcements in their security market purchase program, where it looks like the target country sovereign yields moved the most, particularly during stress periods. So, for example, there's lots of evidence that the ECB's sovereign bond purchases particularly compress spreads. There's other evidence also from Europe that looks at the CSPP, which is the corporate bond purchase program, where it looks really like the purchase programs lowered eligible corporate bond yields a lot, didn't move neighboring bond yields as much or other asset classes as much. So again, very narrow targeted. And I'll talk about this one a couple of times. There's a nice paper by Haddad, Muir, and Moreira looking at interventions during the Fed's COVID QE, in which it looked like the investment grade corporate bond announcements really moved IG yields a lot. And there's other results like that around munis as well as corporate bonds. What I've just walked you through is asset pricing evidence. So if I step back, what does the asset pricing evidence tell me? It tells me that there are some conventional broad channels, and there are some specific narrow channels where the asset being bought is the thing that's moving the most. Now let's look at quantities. And if I take from the asset pricing evidence that what's being bought moves the most, then a second effect you might get is that originations should move particularly with what's being bought. Okay, this is a paper by DiMaggio, Kermani, and Palmer. This is a restud paper, which looks at originations of mortgages by different QE programs. And it goes down the following road, which is the Fed particularly bought conforming mortgages, not jumbo mortgages. If you think the mechanism is that the Fed bought conforming mortgages, moved up the price of conforming mortgages a lot, what you should expect to see is banks originating a lot more conforming mortgages. So you can use the jumbos as a control and ask, is that what happened? That's roughly what happens here. You can see the signs on these jumbos are all negative, which is to say that most of the action on mortgage originations is happening in the conforming space rather than the jumbo space. So that's a way of showing that the quantities that are responding are the quantities of what the central bank is purchasing. Here's another nice paper.
Question.
Yeah.
Of course, the Fed bought typically that tried to buy newly issued mortgage-backed securities.
That's
and
right.
Not legacy issues. Will you go into that?
I'm not going to go into that. I have a paper with Annette for a 2013 Jackson Hole paper, which spends considerable amount of time on that. And you see, in a way, exactly that. And I think actually it made a lot of sense for the Fed to do that. If you take the perspective that what you're buying is what moves the most in yield, and that is what will trigger more issuance, and your objective was, say, to support the housing market, then you should be buying new issue mortgages. That's the most direct way in which to impact stuff. And that is what the Fed was buying. The Fed was buying conforming new issue mortgages. Everything here is new issue mortgage loans. And those, in that sense, those two things match up well.
Would you include house prices also in the asset pricing category, or that's already into macro channels?
No, I think one would have to, but I don't know how to do it. And Marcus, it's the poll question. I think that difficulty, we have fairly good evidence, and hopefully you have now a sense of this. There's a lot more evidence, by the way, along these lines, which is around how QE affects particular assets and particular asset markets at particular times. I think zooming out and trying to ascribe a big portion of the boom from over the last decade in asset values and home prices due to QE is considerably harder. I think to do that, we need to take this evidence, integrate it into some type of bigger macro model, and then see whether we can make sense of what happened more broadly.
Can I just inject another thought?
Yeah.
One way is to buy just this particular asset in order to push up this particular asset because it's very narrowly defined and they're essentially segmented markets. An alternative way would also be to make sure that markets are less segmented. So you help essentially players who desegment markets or combine markets.
That's right. Yeah.
Recognize them, and this way QE would be more widespread rather than only affecting this particular asset class.
Good. Okay. So hold that thought. I think I have some more to say about that. Yeah. Let me just show you one more bit of QE evidence, and I'm showing this to you because it conforms with what I've shown you before. Also because I think this is my interesting research, and we've learned about QE in part from asset prices. I think we've also learned about QE in part from looking at quantities and bank loan originations. That gives us also a window into the way in which QE works. So this is a paper by Rodnyansky and Darmouni, and they look at the following question, which is the Fed bought mortgages as well as treasuries. If you look at the cross-section of banks, there's different banks, and banks are differently involved in the mortgage business. Some banks are more in the mortgage business and some banks are less. If you think it's a narrow channel, then it should be that the mortgage purchases should be the thing that drives a lending. And in the data, when the Fed runs its QE programs, QE1 and QE3 are particularly connected to mortgages. QE2 is a treasury purchase program. You see lending in the cross-section by mortgage type banks respond more in QE1 and QE3, really very little response in QE2, the treasury purchase program. And the type of lending that these banks are doing is real estate lending. So that makes a lot of sense. One of the other things that comes out of this study is that C&I lending in the mortgage purchase program doesn't move very much. So the Fed's mortgage purchase program looks like it spills over to real estate lending, but less to C&I lending. And I don't know the answer to why this is happening, but it's an important data point because it informs us on how to think about how banks are making loan portfolios in response to what's happening in terms of asset prices. Okay, so I'm going to talk you through another study, which I think is also very interesting because it indicates how the impact of QE depends upon market conditions. So this is from a very nice paper by Haddad, Muir, and Moreira looking at the Fed's COVID interventions, so QE interventions during the COVID crisis. And this is what we're graphing here. What they're graphing here is the yields on Google's corporate bonds. So Google's corporate bonds move up around the COVID crisis by on the order of 150 basis points. Google CDS really doesn't move. So this is corporate bond yields on a fairly high investment grade firm, high rated investment grade firm moving up a bunch. The Fed goes out on March 23rd and announces that they're going to roll out a program where they'll be buying corporate bonds. Yields come way back down. That is a very strong effect. It's both a narrow channel effect in the sense that the Fed was stepping in with investment grade issues in mind. And it's an effect that's very sizable, and you can see it's happening in a distressed state of the world. So there was some evidence from 2008 and 2009 that QE actions in 2008, 2009 seemed to have bigger effects. It's hard to sort out how much of that is a function of market expectations and the Fed surprise. So in a way, some of the stuff that you talked about earlier, Marcus, how much of it was because you're in a world in which risk premia are high, and when the risk premia are high, an asset purchase will have a bigger impact. This is, I think COVID has been interesting because it tells us it's when risk premia are high, when the Fed steps in and does stuff, it's going to have a big effect. So you learn something about conditionality from this. The
Fed didn't buy any of these Google bonds, not that just.
And then that was also interesting, right? Which is this is the announcement effect, which is the same as all of the other things I've shown you. The announcement effects are very strong. In fact, in this episode, the Fed actually did not need to buy. It simply stepped in and said, we'll provide some support. Markets reallocated themselves and yields came back down. And I think that's also informative about potentially how to think about what's happening here.
But was it the Google or was it the guys who do this bond CDS, bond arbitrage? They were essentially put at ease or put some extra capital in. Do we know that?
Yeah, I think that's one way of thinking about it. Maybe. I mean, maybe this is where you're coming out. So let me just flip over to thinking a little bit about theory. I think this is where you're pushing, Marcus. So first of all, I think what should be clear to most of us who do research is that if you want a theory of QE, you really have to go away from a complete markets model and towards a segmented markets model, because QE effects are narrow, not broad, right? That jumps out from the event studies. So it's not changing the rep agent's SDF, it's changing the SDF of some narrower set of investors who are significant in a narrow market. I'll say another thing, which is also obvious, which is that if you really thought it was a broad thing, a macro calibration of a rep agent SDF will get you a too flat a demand curve. So it's not consistent with the data. It couldn't possibly be consistent with theory either. So this has to be the right way to think about the world when thinking about QE. And so then the research question is, yes, this is clearly what we need to do in constructing models to be consistent with the data, but what type of model? And then what type of model means what is the narrow market? Who are the players? What are their constraints? That's the sort of stuff that we need to think through. And I'm going to talk through one particular paper. And there's more, I'd say, in this work. It's but I'm going to talk through one particular paper, which I view as kind of the cutting edge of this type of QE work. Right? This is Vianos Vila. I think it's Econometrica last year. It's a model of the treasury market yield curve that tries to deliver a risk premia that are a function of supply, right? That's what it's after. And it does it by mixing two types of investors. One is a set of what I'm going to call safe asset investors, preferred habitat investors who want to buy bonds of particular maturities and want to buy treasury bonds. And then another set of investors, yield curve arbitrageurs, who are willing to go long and short along the yield curve to smooth out the impact of shocks across the yield curve. The arbitrageurs are particularly important because the price of risk in the treasury market is a function of the quantity of risk held by the arbitrageurs. So there's a risk premium that shows up along the treasury curve that is linked very much to the SDF of the arbitrageurs. And what is the SDF of the arbitrageurs? Well, it's a function of how much risk they hold. Okay. So I think this is a very nice paper because it puts two pieces that are probably relevant when thinking about QE. One is how narrow segmented market risk prices are determined, in this case by arbitrageurs, how safe assets are particularly priced, in this case by preferred habitat investors. So what does the model give you? It gives us a way of thinking about risk premia. It gives us things like when balance sheet constraints are tighter, then risk premia are higher. That's some of the conditionality that I showed you, for example, with that Google example. It also gives you a way of thinking about how you can get local effects of duration. Why is it that when you buy the 5-year bond, the 5-year bond moves the most? And the reason it happens in the model is because there are future supply shocks that the arbitrators have to bear. And so if I get future supply shocks to 5-year bonds, I'm going to demand higher risk premia at the 5-year sector. I'll show you one picture, and then I'll just talk you through some things that I think you can learn from this model and maybe avenues for further work. So this is output from the model. And the output here is, take a look at the red line. This is, if the Fed was to buy 2-year bonds, how does the entire yield curve, 0 to 30 years, move? And what you see from here is that the 2-year bond yield moves the most, and long-term bond yields move a little bit less. So that's, in a way, that's consistent with some of that event study evidence I showed you. So they can deliver effects that look like when the Fed buys 2 years, 2 years move a lot. Here's what if the Fed buys 30 years? You get a big movement in 30 years. You get movements all along the rest of the yield curve. Why? Because every bond yield has duration risk. And so when you compress the price of duration risk, you compress every bond yield. Of course, a 5-year bond has 1/6 the duration risk as a 30-year bond. So you compress that about 1/6 as the 30-year bond. So you get SDF risk prices and you get some local effects that play out that look very much like the data. All right, so what can you do with this model? Well, there's different things you can do with this model. One of the things that this model allows you to think about is spillovers. So is the impact of the Fed's treasury purchases moving down 30-year yields, is it only in treasuries or is it broader? And to answer that question, what we need to figure out is that arbitrageur who is going long and short treasuries has an SDF that's pricing treasuries. What else is his SDF pricing? Is it also pricing interest rate swaps? Is it pricing, say, non-investment grade corporate debt? If that was the case, then you can draw a spillover to that risk price is now showing up in other types of bond yields. The model gives you kind of a disciplined way of thinking about this. And although the paper doesn't do this, one could take the model, connect it to some of the data on some of the spillover effects and discipline how much the SDF is responding to this type of risk. So to me, from a theoretical perspective, writing asset pricing models that connect with the empirical event study evidence is, I think, particularly important. And the big payoff is to discipline the asset pricing SDF, to trace out what else moves when a given asset is bought.
So I don't know whether I disrupt here, but
yeah, go for it.
So one aspect, one way to view it is that, markets are very segmented in crisis times. They're less segmented in normal times. So
yes,
the way you would look at the markets would be very different across the cycle in a sense.
I think that's also right. Yep.
And
so for example, you could take the
habitat would be very connected in normal times, not connected along the maturity structure, but also across different asset classes. And that's also why, I guess, the central bank comes in and acts as an intermediary connecting these markets, which normally the financial, the private market would do.
I think that's exactly right. So, and I think this model would deliver that, because once you put down, and basically this is an intermediary pricing kernel, and once you put that down, it's going to tell you that during distress times, this pricing kernel has a higher price of risk. And so different stuff can move differently. Whereas during normal times, there's effectively more capital in the market, which makes market prices more integrated. And that has two implications. It would imply, in a sense, less spillovers during distress periods, but it'll imply smaller effects during normal periods. Right.
But then if you go from an ex-ante perspective, if the intermediary sector knows whenever there's a crisis, there will be a Fed jumping in and connecting everything again.
Yeah.
Are there moral hazard considerations we have to take into account?
Yeah.
Or
yeah.
That's not the funny.
No, I'm sure. I'm clearly yes. I guess the answer is clearly yes. So I'll step back and just say, from a research perspective, I think if we develop models like this that can put more structure on this, then I think we can go ask the next question, which is the question you're asking, which is a policy design question. I think we're still, this is about my take on research. I think we're pretty good in the event studies. We're still working on this stuff. We could do more, and we need to do more before we can get to the harder questions, which are the questions you're raising. Let me just say, and I'm not going to spend too much time on this. We've been particularly interested from a central banking perspective in the impact of the Fed buying a given asset. But we know we can learn about the impact of the Fed buying a given asset by looking at somebody else buying that given asset. And it's an example of that is Markus's example of the Treasury changing issuance policy. But you could ask a pension fund going out and buying unexpectedly a bunch of mortgages, or someone changing a mandate and suddenly having to buy a bunch of corporate bonds. All of that is informative. And the nice thing about looking at those types of events or those type of experiments is that they're not commingled with monetary policy actions. So there is, in finance, I think, a growing research area which tries to do this, which tries to think about intermediary SDFs, market segmentation, specialized demands, thinking about them for equities as well as for corporate bonds. And this research has not connected to the QE work, but it's very relevant for all of the QE work. And if you want, taking this, connecting it to things like Vayonas Vila and putting together a sort of a systematic view of SDF that connects and integrates markets, I think can be very helpful in teaching us about how QE works as well. So that's just a plug for more of this type of research. Let me flip to the next set of things that I want to talk about, unless you want to stop me here, because I'm done with asset pricing. I'm going to talk about macro a bit.
That's good. Let's cover macro too.
Okay, so the big picture question, of course, with QE is what's the impact on things, bigger things like employment and output, not narrow things like the price of a 5-year bond. And I'm just going to draw an analogy to conventional monetary policy. So, conventional monetary policy research basically tries to look for identified monetary policy shocks, and in different ways tries to run some type of projection of those shocks on economic outcomes like output inflation, and then trace out quantitative channels. And if you open the hood on what's happening there, what you're looking for is a policy shock that, say, moves real interest rates, maybe changes the user cost of capital, then affects investment, changes a interest rate in a household wealth equation, and then changes consumption savings behavior. And all of that together ends up affecting employment output. That's sort of what we think is happening under the box when we're moving, under the hood when we're moving conventional monetary policy. Let me draw the same analogy to QE effect. So in principle, we can look at QE the same way. We have a QE shock. We have QE shocks that are fairly well identified. One of the things about the QE shocks is that they're moving particularly prices in the targeted markets, right? Buy 5-year bonds, 5-year bond yields. Buy mortgages, mortgages move. Buy corporate bonds move. Okay, so not broad, but particular. And then, but we can then run through the same channels, which is if you move a particular targeted market, say corporate bond yields, does that change user cost of capital for firms? Does that change investment? If you change, say, mortgage rates, does that change household behavior in the mortgage market? Does that change household consumption? And that's the way in which we think employment and output is affected. So big picture, same things at play, but small picture, one thing to keep in mind is we're changing interest rates in targeted markets. Okay, and I want to just drill down on that a little bit more to tell you that because we're changing interest rates in targeted markets, the way we think about macro policy effects should be different than the way we think about them in the conventional space. So to make this point, I'm going to go back to the Google example I showed you before. Again, in COVID, Google investment grade bond yields spiked by about 150 basis points. Okay, very significant. If I told you that the user cost of capital for Google went up by 1.5%, you would say that should have a big impact on investment. Now, put down though the perspective of corporate finance on Google. Corporate expenditures would only respond to QE if QE affects the user cost of capital and the marginal unit of capital. So one of the things that is very clear about Google is Google has lots of cash. And the marginal source of capital for Google is almost surely cash. It's not the corporate bond market. What that means is that this spike of 150 basis points is probably irrelevant for Google's investment decision. On the other hand, now, if I said that what happened was that conventional monetary policy brought interest rates down by 1.5%, both on corporate debt as well as on the return on Google's cash, then you'll say, the user cost of capital for Google has changed, and so investment would have changed. But if understanding that QE works through these narrow effects and seeing that what the Fed's corporate bond purchase program did was to lower corporate bond yields by 1.5%, actually, if you look at this, you'd say this corporate bond QE should have had no effect on Google investment, because the marginal source of capital is cash, and the price of cash didn't really change with this action.
Arvind?
Yeah.
But if the Fed cuts interest rate by 1.5%, Google's investment will not change either, in a sense. Do you think because they get less on the cash, they will suddenly invest more?
I would say that they would. Their cost of borrowing or their cost of cash has changed. So if I'm doing standard corporate budgeting at Google, I'd say, gosh, my cost of capital just moved by 1.5%.
They will pay out the cash because they're constrained based on ideas and other limits rather than financing constraints.
Okay. I mean, that now you're telling me that the Google's production function is very special.
Yeah, it's not, probably they can't just scale it up.
The same way. Maybe it happens slowly.
Yes, fair enough.
Okay. Yeah, I don't know Google's production function well enough. So I want to just make a corporate finance point about Google in particular, and about an investment grade firm in particular, which is just because you bring down their corporate bond yields doesn't mean you will have an impact on investment. For an investment grade firm that has other sources of financing, it may not matter at all. And in fact, there's actually reasonably strong evidence for this no effect. Two papers I cite here, which basically look at firm behavior around the COVID crisis, give you strong evidence that there's sort of a no effect here, that all we're doing is shifting around financing terms, but there's no real investment effect.
But here in this particular COVID thing, you have to wait until Google wants to issue a new bond. No? This was very too short, essentially, in March 2020.
Maybe that's the answer, which is Google isn't rolling over debt here.
Yes.
Right. And if Google was rolling over debt, then maybe it matters. But again, the point for Google is it has lots of cash.
But my understanding is the reason they issue bonds and hold a lot of cash is all for tax arbitrage reasons. They park some cash in Ireland and have to issue some bonds in order to keep this cash in Ireland.
And so then once you have the cash, you can use the cash.
Yes.
Right. I mean, again, we sort of know, and I'm not going to go too deeply into this. I think the Acharya Stefan paper makes the point that we know that during this period, firms start to draw down bank credit lines, and so they have. It's not the alternative is not cash. It was a credit line.
Yes.
That was the source of financing. But I'd make the same point, which is if the cost of that credit line didn't change, and that was the marginal cost of financing, then by bringing back the investment grade bond yield down, you're not really having an impact on the firm.
Will you talk about this Dan Greenwald paper as well, where essentially he argues that because the Fed intervened and brought the yield down on the corporate bonds, it made it possible for the banks to free up some capacity to lend to SMEs. And this was a big macro effect, essentially. So you subsidize essentially the corporations through QE, corporate bond QE. Mm-hmm. And suddenly they didn't need to go to the banks anymore because they're in the corporate bond market. And then the banks had the capacity to lend to smaller companies. Mm-hmm. And you wouldn't see it on the big firms, but you see it on the smaller firms, on the SMEs.
Good. Okay. Yeah, I will say something about that. Let me just make one more point here, and then I want to go. And I'm just making this point just to highlight that the way to think about the macro transmission is more nuanced than we think about with conventional policy. So I'll take the same example. Take a firm with 5-year bonds and 5-year bank loans. And let's suppose that bond investors increased the risk premium they were charging on corporate bonds. Let's suppose banks also increased the spreads they were charging their loans, but the bond investors increased it more. Since the firm's going to tap the lower source cost of capital, which in my example here is bank loans, if you're thinking about QE that wants to impact corporate investment, you should actually target the financing with the lower yield, the less fire sold asset, which is in a way counterintuitive when you first think about it. You think the corporate bond yields are selling off, but if that's not the marginal source of financing and bank loans are selling off less, then find a way to make bank loans cheaper if you want to affect investment. All right. So the point being that, you know, when we go from asset pricing to macro, and we think about firms, we kind of have to put some layer on here to make sense of how to think about QE. I think I mentioned this before. There's actually nice evidence also from Europe, which is corporate bond purchase program, lowered bond yields but had limited impact on treated firms' investment. The effect that had, and this, Marcus, is related to what you just pointed out, is banks that were more exposed to treated firms increased lending to other firms, which is a spillover effect. That seemed to be the impact that happened. And so then maybe a different way of thinking about some of these corporate bond purchase programs is more linked to the Vayonas-Vidal model. What you're doing is, by going out and buying distressed debt, you're changing the capital position of banks, the quantity of risk that they're holding, changing their SDF, and then making them more willing to lend to others. And that's like what you just mentioned about Greenwald's paper about SMEs. And that seems like a kind of a very plausible way of thinking about the world. So, you know, if it might be that the important effect of QE is running through an intermediary SDF that determines asset prices, which is different than thinking about how firms are responding to this sort of stuff. And so this is very similar to thinking about Vayonas-Vidal. If you think that there's an intermediary SDF that determines asset prices, and you're running through that intermediary SDF, then that's the way in which you're impacting asset prices. So, you know, if I took an intermediation channel of thinking about how the Fed's QE is working, then what the Fed should do is purchase the fire sold assets to shore up the balance sheet of the intermediary and lowering risk prices. So I'm just going to make a broad point then, which may be, suppose I told you that the world was a mix of corporate financing type issues as well as intermediation issues. Then maybe what you want to do, if QE is a tool of monetary policy, is you want to buy expensive bonds in normal times and cheap bonds in distressed times. And what I mean by that is, in distressed times, it's intermediary SDFs and spillovers. That's the mechanism through which QE should be working. In normal times, it's not an intermediary SDF. It's directly different asset markets and, say, lowering the yields on corporate bonds versus bank loans. So buy the cheaper source of financing, which is the expensive bond in normal times, and then flip over and buying the cheapest bond in distressed times. I mentioned this, I mean, it's sort of provocative. It's just a way of making the statement that to go from the asset pricing to the macro, there's more modeling of firms and banks that needs to be accounted for. And I think doing so might lead you in different directions about thinking about optimal policy. So in my mind, there's sort of ample room for more modeling work here to interface with data patterns. So I've maybe this is clear from what I've said. I feel like we're quite far from a compelling macro finance model to study QE. You know, in a way, the simple thing to do would be to take a macro model, say with a risk premium, like a term premium, and imagine that QE impacts the term premium. I think that's wrong. You can't do that because it's clear that from the asset pricing evidence, QE is impacting risk premium, but then understanding how that ends up affecting firms and household behavior has many steps that need to be accounted for more systematically, because QE is working through narrow channels. And so in my own mind, I'm kind of uncomfortable with where we are with macro finance models studying QE. You know, in the poll that you had given before, I feel like this is the place where we know the least. Maybe we're not even there to build up these models, but this is the place in which we really know the least, where we could really do a lot more research. So, you know, if you ask me, I think research here, we're still at some level of the insight stage. We know that asset market targeted matters for transmission. We know it's more subtle than if you just buy stuff, good things happen. We know that crisis interventions are more powerful than non-crisis interventions. And then the last thing that I'm going to say is we also know that communication matters. And I'm going to say a little bit more about that, maybe in the context of QT. Yep, go ahead.
Perhaps 1 minute.
Okay, so I think this is really, I'm hitting the end here. So this is the last thing I want to say. I think one of the things that is also clear with QE announcements is that it comes coupled with indications about conventional policy. And the reason is because markets are not sure whether QE is just about asset purchases or it's about other stuff as well. We're sitting in a world today in which we're thinking about quantitative tightening. And it is likely the case that markets are more confused about the reaction function on conventional monetary policy now than ever before, partly because of what has happened with inflation. So I think a lesson from some of the past QE research is that in that environment, it's probably going to be the case that any actions over QE are also going to be informative about the conventional policy reaction function, so that there's going to be strong communication effect. So if you ask me a lesson and sort of an insight lesson that I learned from some of the research that's relevant to QT, it's be very careful with communication, because we're unsure about the conventional reaction function. Almost surely announcements about QT will inform the market about conventional reaction functions. And so it pays to be even more precise in separating those two things.
So you expect another taper tantrum?
I would be worried about a taper tantrum if we don't handle communication clearly. I mean, I think this is the worry sitting here today.
So if you want to tighten now, you would rather tighten with interest rate rather than through.
I mean, the Fed's been working super hard in trying to delineate these two policies, right? Their sequencing strategies, et cetera. But I think what I have learned, say, from the taper tantrum is, and generally from the stuff, is that as hard as they try, there's still confusion.
Let me come back for 2 minutes or 3 minutes, just to some questions to summarize the main questions at the end. Of course, what you're proposing as a macro model is a very challenging exercise, because when you go to segmented markets, you have many state variables. Each segment of the market has its own wealth share, and that will be is a challenging exercise. And I think probably with machine learning and other algorithms, we might be able to handle bigger models and go to the data with them and come to these insights. But it is a big challenge. But I was struck by one thing, what you did not say, or perhaps you can summarize the wish list at the end. You did not mention in any point in your talk the zero lower bound. And that was the initial starting point for QE that we said. But in any of these arguments brought forward, there was no reasoning that we have to do it when we hit the zero lower bound. So all of these reasons you brought forward, we could do it at 2% interest rate or 3% interest rate too. If you think, oh, there's a friction there and the markets are segmented and there's some problem there, we can fix it through quantitative interventions. Would you agree with that, or do I push too hard?
So I guess it's clear that QE was born because of ZLB.
Yes.
We have learned a lot about QE, and maybe we have more to learn about QE. And I think we should be open to asking the question, is there what is the appropriate role for this new policy?
But it has huge, so I'll come back to my redistributive monetary policy, it has huge redistributive consequences. And then you open up the whole political problems the central bank goes into it. Because you favor one sector over another sector. If it's not a Pareto improvement for everybody, then it's hard to say, okay, we favor this particular segment in the market because they're financially impaired, in order to help them out. And then might raise a lot of political
starts
issues.
to look like industrial policy.
Yes.
Yeah.
And finally, let me just, perhaps you can go through the wish list and add just Laura Allen's question to it. Ben Bernanke at some point said, QE gives you another 3% extra policy space beyond the zero lower bound. would you make such a bold statement, or is there any way to quantify it, or do you think it's much more nuanced? You have to look, where's the bottleneck, and then intervene there, and rather than just saying, well, this is like an average macro model, and it just relaxes the zero lower bound.
Yeah, I don't feel like the data allows us to say, or anything that I've seen allows us to say 3%. Okay. It feels much more nuanced, and it feels like specific markets. And as I said, it feels like specific times. It's clear, for example, that COVID corporate bond purchase program, you had huge impacts. So this must be a conditional statement as well.
But you said, you had a huge impact. It didn't impact the real economy, ultimately, in a sense. So yeah. Helping out Google's, was it just
didn't impact Google,
finance thing, but not the macro thing.
Yeah, but it could have impacted it through the mechanism that Greenwald proposes, which is it freed up space and then impacted the way in which banks make lending decisions. Mm-hmm.
Perhaps we end here, and you just give us a 1-minute summary of your wish list.
Yeah, so this is me taking stock of where we are on QE research. I actually feel like we have lots of very good asset pricing work on QE. And I guess if I was like a planner allocating research time of all research economists to stuff, I'd say we've got this one pretty well covered. I think we could do more here. In sort of sense, we need to do more here because it's what's going to inform us about spillovers. We have far less evidence on macro consequences. I mentioned a couple of these bank lending papers. We have far less than we need. And the reason why more of this is useful is because we want to connect the asset prices stuff with the real stuff, and we need data to help discipline models. And then, I think we're still in very early stages of positive macro models. And part of it is what you mentioned, Marcus, it's hard to deal with these models, but actually I think we have made good progress in being able to construct, multi-sector financial market models with different SDFs. So to me, it's actually not a computational issue. It's more what's the right model to write down that's consistent with the data. And if we do all of that, then maybe we can answer the other questions, which is the questions you have raised a couple of times, which are the normative questions about optimal policy and policy communication, moral hazard, ZLB, all of that sort of stuff. But I'd like to see much more of this to get to this point first.
Thanks a lot, Arvind. I think we have a lot of work to do in the next 5 to 10 years, I guess.
Yes. Mm-hmm.
It was so fascinating to see, how you put things together. I think you had a very nice structure in your talk, and that makes it much clearer where the open holes are and what we still have to do.
Okay. Thank you for listening to me, everyone. And thank you for having me, Marcus.
Thanks. Thanks, everybody. Bye-bye.